Hello, everyone. Welcome to our DAT IQ Weekly Market Update. This is our update for December 12, 2023, episode 273. It's our second last show of the year. I'm Dean Croak, market analyst here at DAT, sitting in for Ken Adamo. And today I'm joined by Todd Amon, our special guest today. Good morning, Todd. Great to have you with us.
Hey, Dean. It's really nice to join you here at the end of the year and get caught up before we close out 2023.
Yeah. Todd, you've been on the show a few times now. We really love having you on every now and then just to talk about operating costs. But for those new to the show and don't know you, tell us a little bit more about ATBS and your Denver-based operation.
Yeah, you bet. I'd be happy to. So we're celebrating our 25th anniversary this year, which is fun and exciting. It's hard to believe we've been doing what we do that long, but the essence of our business is we work with independent contractors, carriers, I think you would refer to them as in DAT. Our typical customer size is one truck, one driver, but we've certainly got quite a few that might have 5 or 10 trucks for sure. The small, fleet size capacity we deal with, and really what we do is their books and taxes. So our business is built around taking all their information every day and consolidating it into meaningful financial information to help them manage their business, and then also helping them do their taxes. So we work with about 20,000 contractors a year. And so the really fun thing about what we do, besides accounting and tax, which is always fun, we get to do a lot of analytics out of that data and make sense of what's going on in the market. So it's kind of what we spend our days doing here.
Fantastic. Yeah, much needed service. All right, we'll bring Todd back a little bit later in the show. Let's dive into the market update side of our show. For those new to the show, remember we're here every Tuesday, 10 a.m. Eastern, 7 a.m. Pacific, talking about trends in the freight market. Most importantly, we're here to answer your questions, get them into the chat section. We've got a team in the background processing those, and we can get to those towards the end of the show. You can also find the long-form version of the show report at dat.com this evening. A lot of the charts and graphs will be in there. So let's get going with our key trends that we're watching. Spot rates and volumes fell back last week following the prior week's surge. I put an asterisk around normal. I'm not sure what normal means at the moment. We're seeing a little bit of seasonality, but volumes are certainly way down compared to last year. On the contract rate side of our business, contract rates on the main for average rates in routing guides flat in the first 2 weeks of December versus the second half of November. Replacement rates based on recent RFPs down 8%. From 4%. You'll remember from prior shows, they've been decreasing at double-digit rates for most of this year. The rate of decrease had slowed, but it looks like it's ticking back up again on some of the more recent rate negotiations. ISM PMI last week, still in contraction territory. New orders are declining. Watching November imports, a little bit more volume coming back to the West Coast. East Coast volumes are dropping. A lot of volume drops out of the Gulf Coast due to the Panama Canal. We're seeing import volumes down about 22% in November compared to October. So we're seeing a lot less volume coming to the Gulf Coast. Volumes down about 9% month over month. Last month's volume was about 6% higher than last year on the import. So October was the peak, a little bit later than prior years. And compared to November, going back 8 years, last month's import volume was about 5% higher, to put some perspective around what those numbers mean. I think it was about 2.3 million. Class 8 truck holders up. ACT Research on our show last week. You can catch that show on YouTube if you like. Tim Denoy was talking about some of the order trends. So let's dive into the market update. Let's start with load to truck ratio. Load to truck ratio down to about 1.94, back under 2 after almost doubling the prior week. Load post volumes in dry van are sitting about 65% lower than last year. So certainly some low load to truck ratios, as you can see on the chart. In refrigerated, after doubling the week prior, that would have been the week after Thanksgiving, load posts were down about 38%, erasing all of the prior week's gains. Spot market for us is impacted a lot by lower produce volumes, mainly in California. Volumes are down 39% compared to this time last year. They push out about a quarter of the load post volume for us. Load to truck ratio back to 2.11 last week. And in flatbed, load post down 25% last week. That market is certainly cooling off. Load to truck ratio sitting at about 5.19. Having a look at a couple of our markets this week, I wanted to focus on the Houston market initially. State average outbound rates in Texas at the sort of the national or the state level, sitting around $1.49. That's 6 cents a mile higher than this time in 2019, sitting about 14 cents a mile higher than 2022 this time last year. Having a look at Houston, rates are up for the fourth week out of that market, up 3 cents last week, averaging $1.44. Remember, folks, these are line haul rates excluding fuel. Houston to Dallas, one of the busiest lanes out of Houston for dry van. It was the lowest in 12 months at $1.90. Regional loads to Shreveport, much better, paying carriers $2.72 a mile. Spot rates in Elizabeth, New Jersey, up for the fourth week, averaging $1.31. Some of the big lanes out of Elizabeth, Columbus, Ohio, at $1.31, identical to this time in 2019, but almost a third of what spot rates were at the peak of the sort of the pandemic influenced era at $3.21 in February last year. Los Angeles capacity tightened last week, spot rates up 7, outbound rates averaging $1.36. On the busy Phoenix lane, a lot of imports head east to Phoenix and sit in warehouses. Carriers were paid on average $2.88 a mile last week. They've been sitting about that level for the last 6 months. That's about $2 a mile lower than the peak in December of 2021 when imports were surging into Los Angeles. Having a look at the refrigerated market, Pacific Northwest, again, fall produce is a big influencer up there. Some of the USDA data is very interesting. 5 of the 19 produce growing regions covered by the USDA reported a slight surplus. Only McAllen in southern Texas reported a surplus of reefer trucks last week. There's a big difference between a slight surplus and a surplus in the USDA data. Fire off a question if you want us to dig a bit deeper into that. Pacific Northwest, trucks are obviously harder to find this time of the year. A lot of Christmas trees and winter produce coming out of that market. Shortage of trucks for loads of onions and potatoes in Idaho, Oregon, and Washington. Capacity was the tightest in the Columbia Basin in the Pendleton freight market. One of the lanes we watch out of that region is Yakima Valley to Los Angeles. Paid carriers on average $2.27. Rates forecast to go up about another 10 cents a mile by the end of the year, according to our Ratecast product. In flatbed, last week's national domestic raw steel production numbers from the AISI up 7% in the last week. Flatbed carriers in Gary and South Bend, Indiana, seeing some pretty good volumes come out of there. About 30% of our domestic steel comes from those two freight markets at the bottom of Lake Michigan. Generally, the flatbed market is oversupplied still. Flatbed capacity is impacting spot rates in that market. They're sitting about 6% lower than this time last year in Gary and South Bend, sitting at about $2.45 and $2.42 a mile, respectively. A lot of short-haul loads out of Gary and South Bend. Gary to Cleveland averaged $2.62 last week, almost identical to last year. And loads south to Cincinnati paid carriers $2.89. That's about 10 cents a mile higher than this time last year. And wrapping up our year-over-year look at spot rates for dry van, following seasonal patterns mostly, they were down about a penny per mile last week, sitting at $1.66 a mile. They're 14 cents a mile lower than this time last year. And as you can see on the chart, sitting almost identical to this time in 2019, about a penny per mile higher as of last Saturday morning. And on our top 50 lanes, based on the volume of loads moved, they averaged $1.96 a mile last week, maintaining the 30 cents a mile spread with the national average. In refrigerated, line haul rates lost most of the gain from the prior week, or prior 3 weeks actually, down 5 cents a mile last week at $1.94 per mile. They dropped back to where they started November and sitting about 2 cents a mile higher than 2019. And lastly, in flatbed, flatbed line haul rates averaged about $1.90 per mile last week, down about 2 cents per mile. They're sitting about 14 cents a mile lower than this time last year, and a little bit higher than 2019 by about 5 cents per mile. So that's it for this week's market update. Remember, if you want to find out more about what's going on in freight and get a copy of some of the charts, our market update will be uploaded this evening. Just go to dat.com/market update. So let's have a look at our short-term forecasts now. Not a lot to see here. Fairly strong seasonal effect going on right now. These are our short terms going out 35 days. For those new to the show, the blue line is our rolling 7-day weighted average of historical rates for loads moved. These are over 550 miles. They exclude fuel, so they're line haul only. Our flagship model Ratecast, which is in all of our products, is the green line. The red line is the short-term model. It more heavily weights data seen more recently, and then you have the yellow and grey blends of the two in varying degrees. So let's start off with dry van this week. A lot of model agreement in all three equipment types. They all look much the same. No need for a lot of deep analysis. No surprise here. They all go up and to the right. In dry van, you can see a fairly strong upward lift on the right. The reason's fairly simple. There's lots more just-in-time freight to move, as Zach Rogers explained recently on our IQ show. The other thing to watch is capacity continues to exit the market, even though that rate of decrease is slowing. But that's on top of fleets beginning to route drivers closer to home. They become more selective with loads. The radius of operation basically begins to shrink as we get closer to the holiday period. Once we get to Christmas, we typically see about 10% of truckload capacity on the sidelines between Christmas and New Year. In dry van, I went back to last year. The same week last year, we forecast a 30-cent per mile lift from 180 to 210 over a 3-week period. It ended pretty much where we forecast at $2.02. This year, as you can see on the chart there, Ratecast is expecting a 17-cent per mile lift in the next 3 weeks. Let's go to refrigerated. Very similar story. Same scenario will play out. This year, Ratecast is forecasting, or this week last year, sorry, Ratecast forecast a 30-cent per mile lift from 210 to 240. It ended the year on 12/31, slightly higher at $2.43. This year, we're expecting a 21-cent per mile lift in the next 3 weeks. And to end with flatbed, expecting rates to go up, but not as much as reefer and dry van. This time last year, also predicted a 30-cent per mile lift from 205 to 235. They ended the year sitting about 222, slightly lower. This year, we're looking for about a 10-cent per mile lift between now and the end of the year. So that's our forecast there. We're going to bring Todd back in and dive into our question of the week. So great to have you back, Todd. Question I wanted to sort of start off with before we dive into some of the nuances around the market. How have owner-operators and small fleets weathered what I'd call a perfect storm of high diesel prices and decreasing freight rates this year?
You know, Dean, it's a great question, and gosh, there's so many answers to that. The smart drivers have done okay, right? If I'm a smart driver, there's always going to be freight moving, and the thing that I love about small businesses, an owner operator or a small fleet, is they can literally adjust their business model that day, as
Right.
opposed to someone that's got 100 or 1,000 or 10,000 trucks. It might take weeks, months, or years to adjust to really high escalating fuels. So it's funny because we didn't see really the reaction in 2022. People didn't adjust to the market like they should have when fuel spiked. They kept driving fast. They didn't drive extra miles. They kept their habits they got during COVID. I think we finally have seen in 2023 the people that are left have realized they've got to do things to make money in this market, and that's drive slower and run more miles. And so we saw those trends really start happening. Gosh, I'd say in the second quarter of this year. Honestly, we expected it to happen in probably the third quarter of last year, and it didn't. It took a long time. It took 3 quarters longer than we expected. So we do see people. I just drove last week from Arizona to Colorado, and I-40 is such a amazing truck lane. It's just
Right.
incredible. It's like the trains beside the highway and the trains on the highway. There's so many trucks. And I did that trip during COVID, and people were driving 80 miles an hour, and trucks were passing me right and left. I was driving the speed limit at 75, and this trip I really felt like people slowed down. Trucks had slowed down. So it's been a tough year, there's no doubt, but I think smart drivers have figured out how to make enough money to survive during this time.
When you say smart drivers, would you be able to discern the difference between, say, an independent contractor, someone that's power only, owner-operator power only, and say a small fleet? Like, or do you think they've all changed their behavior, or is there a difference?
It's a good question. I guess if I think of a small fleet, for me, that's someone below 25 trucks probably, and they're pretty tightly tied to the people that drive their trucks. When you get over that and you got 50 or 100 drivers, it's, they're kind of out there doing their own thing, and it's hard to manage them. And so I think for sure that one truck, one driver they're making good decisions today for
Mhm.
themselves. But
Right.
even that 10 truck fleet, the owners talking to their guys and saying, hey, we need to do this or that to make money and survive.
Yeah, it's with the in sort of this post ELD era, you've got a lot more drivers out there trying to compress, the same amount of work, maybe more into a tighter window now. So my observation when I go out in my truck and sort of sit around the speed limit is I see a lot of guys flying past me, no matter how bad the weather is. But I'd rarely see an independent contractor go past me. ICs with their own truck and trailer tend to be, much more cautious just from a safety perspective, but also more economical in how they manage. I think they tend to manage trip planning a lot better. They do more miles in each hour as opposed to more miles per hour. There's a huge difference when it comes to running a truck. But I think there is a big difference when it comes to fleet size as to how carriers are behaving out there.
Yeah, I agree completely with you, Dean, and it's amazing. I was driving with my parents, so we made quite a few stops, and it's always incredible when you pass that truck that's doing 60 or 65 miles an hour, and then you stop and get some gas or
Mm.
some coffee or go to the bathroom. You make 4 or 5 stops in a day, and that truck will pass you while you take your 20-minute stop. You'll pass
Yeah.
that truck, 5 times during a day, and meanwhile they're just hammered down for 11
Mm.
hours,
Yeah.
62 miles an hour, making
Uh,
money.
Yeah, I saw that when I took my son to Lake Tahoe. We did a 3,000-mile cross-country trip, and we'd stop every couple of hours to feed our dog and, go to the bathroom and fill up with diesel, fill up with gas. And trucks would be, filling up with diesel maybe once a day. But we would pass trucks maybe, they'd go past us, 10 hours later, like we'd catch up to them again because they just continue to run the miles. So, Todd, let's dive into some of the numbers here. What has owner operator income looked like this year? Been a down cycle, margins have been tighter. How has it ended up this year for your cohort of owner operators?
We'll wind up, I think, the average of all of our drivers, so 20,000 drivers, we should wind up right around $63,000 net income at the end of this year, and that's low. At the height of COVID, great market, that average was about $73,000. So we all know that inflation in our personal lives has been a lot, and so $63,000 is, I think, down below where drivers need to support their family and their home these days. So it's definitely a
Mm.
bottom of the barrel number.
Right. Todd, are some drivers reducing the amount of income they draw to get by, or is that kind of a fixed number regardless?
I think at the end of the day, a lot of drivers, unfortunately, like a lot of Americans, live paycheck to paycheck, right?
Mhm.
And so in a good market like COVID, they set some money aside probably, but in today's world, they're putting everything they make in their business to cover home expenses and probably
Mhm.
cutting costs at home because they're not making enough to support a lot of that stuff
Mhm.
that they built up overhead on in the COVID days.
Yeah. In some of my analysis on operating costs, it looks like where rates are sitting and operating costs are sitting, carriers are not generating near enough equity in their business to, trade up. It's more of a negative cash flow trade down type scenario. But I wonder about their ability to generate enough profit to cover major downtime. Like that to me, it seems to be the missing component here with where rates are, is just an insufficient buffer in the event of that inevitable in-frame rebuild or something major.
Yeah, you're 100% right, Dean. There's just no extra money. Every penny I make is going to support my business in my
Mm.
home. And the thing that I think we are seeing is drivers are running more miles, and it's kind of amazing to think back to like 2019. Our average driver was running about 105,000 miles a year,
Mm.
and at the height of COVID, they were running 85,000 miles a year. So that's a huge reduction, right? About
Yeah.
20% in miles.
Right.
So that downtime, it
Yeah.
was there,
Right.
and so drivers are starting to run more miles today because they have to just survive.
Yeah. Yeah. We're seeing that on our end of the business. Obviously, there's fewer loads where trucks are, so they've got to run obviously more miles, but also more miles in between each loads to get that good load. So following on from that, what are owner operators that are surviving in this market doing differently this year?
I think it goes a little bit to your question of the week and something we started talking about kind of early on last year when things started getting tough. It's really fairly simple to operate a truck. I mean, it's not, but it is. We started saying plus one, minus 10. That was kind of like our mantra. And plus one meant take an extra load a month because drivers got used to during COVID having weekends off
Right.
and,
Mm,
driving 20,000 miles less a year. So take one extra load a
mm,
month. That's
mm,
not really that hard to do. And that could give you close to $7,500 extra net income on your bottom line. When you start talking about fixed and variable costs and all those things, I'm already covering my fixed costs if I'm running a business that's making money. So that extra load a month is highly profitable. The minus 10 is slow down 10 miles an hour. And that's not for everybody, but drivers, we talked about it. Drivers really got used to driving fast during COVID because there wasn't traffic, because fuel costs were low.
mm,
And when we saw fuel costs spike last year, we really didn't see drivers slow down. But that 10 mile per hour slowdown can save me 10,000 bucks a year. So,
mm,
I kind of talked about our average drivers lost $10,000 of net income in the last 18 to 24 months. But if I'm that smart driver and I took an extra load a month and I slowed down 10 miles an hour, again, that sounds simple, but it's hard to do in reality. But I could save 15 to $20,000. I could actually make more than I did during COVID if I did those two things. The market's just been really slow to react and do those things, but finally this year, many people have done that.
mm. Do you think that's a lot to do with the relative newness of those carriers as opposed to longer term ICs that have been through multiple market cycles? You think that they're slow to adjust has been more with the more recent entrants to the industry?
Yeah, I think for sure it's that. If I just went out and got my own truck and started driving as an owner operator during COVID because things were great and I had the money,
Right.
I've never been through a down cycle, so I don't know how to react. But I
Mm,
also think it's just because people made a lot of money during the
mm,
COVID years and there
mm,
was money in the bank
right,
and so until I'm broke and I can't pay the mortgage and my automobile payment at home, I don't necessarily react to the market like I should. And
right.
it just took a lot longer, I think, for that to happen
Yeah.
than it has in the past.
That kind of leads into one of the other questions I want to ask you, and that's about why has capacity taken so long to leave the market, given how difficult this year has been?
Yeah, when I think back through past cycles, Dean, and again, I live in the owner operator world, so it's 10 to 15% of the overall capacity of the
Mm,
market. But it's a lot of times, I guess, that excess capacity that comes and goes that really pushes the market up or down.
mm,
And in past cycles, the trucking industry, financial companies have made it really easy to become an owner operator, meaning no
mm,
money down, fairly inexpensive used trucks under 50 grand. And so there wasn't a lot to lose when things got tough. I just gave up, bank, take my truck back, or fleet lease
mm,
purchase, take my truck back, whatever it was. And so I think capacity left pretty quickly. I think the owner operators that came in during COVID were different. There were many that put down significant down payments on trucks, and
mm,
trucks were really expensive, right? So 10 or 20% on a $120,000 used truck was 30 or 40 grand. And
mm,
so I've got a lot invested. And so I'm actually going to do everything I can to
mm,
not lose my owner operator business. That plus people made good money. The government gave people a lot of money, and I
mm.
just think it's taken a lot of time to burn that off
Yeah.
as opposed to what it has in past cycles.
Yeah, I tend to agree. I think there's been a big bifurcation in the market. Normally in down and up cycles, operating costs tend to work in a fairly tight band. This time around, I've seen a much wider level of operating costs because some carriers paid off a lot of debt levels. They can reduce their rate per mile in terms of break even, but some of those carriers that paid triple for a used truck in the pandemic got much higher operating costs this time around.
Yeah.
Todd, one of the other questions I wanted to ask is a lot of owner operators have left or are leaving the market, probably will do so at the turn of the year. Do you see new entrants still coming in? We still see it on the carrier authority side. What are you seeing in your side of the business?
What I love about trucking and I love about just people in general is the American dream is to own my own business.
Right.
And You and me, Dean, who've been around this business for a while, if you said, why don't you go buy a truck and become an owner operator right now, you'd say, that's the craziest thing I've ever heard. This is a brutal market.
Right.
So maybe if I can make it in this market, I can make it in anything. But why in the world would I become an owner operator right now? There's
Mm,
no good news at all.
mm,
But we see new drivers every day. We sign up 800 to 1,000 new clients every month. And we just had a guy last week who cashed in his 401k, been an employee for a long time, and took 50 grand and bought his own truck, and he's becoming a flatbedder. And so we do definitely. I
mm.
and I and I guess if I've been driving a truck for 30 years and I've got enough money saved up, or I've got the dream, or something changes in my life where I can take the risk, it's the dream
Right.
to own your own business. So
Yeah.
yeah, we see new entrants as much as you think it wouldn't happen right now. There's
Yeah.
plenty of new people every day that come in.
Yeah, it's one of the more fascinating things I've been watching this year. In November, when you look at carrier authorities for interstate carriers, we had nearly 8,000 carriers either join or reactivate their authority, and about 10,300 leave. So 10,500 left, right? Had enough of the industry and revoked their authority, but we still had nearly 8,000 join. And it's always fascinated me about what they're seeing in the market. We had Zach Rogers sort of explained last week. He thought a lot of capacity was moving into areas where there was demand, and of course, a lot of that could be short term if it's final mile, warehouse replenishment, store replenishment type work. That'll certainly slow down in the new year, which kind of leads us to one of the final questions I wanted to ask you. And we're asking this on all of our shows in December with all of our industry experts on. What do you think 2024 is going to look like?
Wow, that's such a big question. And so if you ask me analytically and numbers wise, I would say it's going to be a really mediocre break
Mm,
even year.
right.
But I also remember, I think I was on your show in March of 2022, and we had just surveyed a lot of our partner carriers, and we work with all the large carriers that have owner operators that run for them, as well as 20,000 drivers. And there was no end in sight to the good market. It
Mm,
was, like in January, February, we asked that question, how long is the good market going to last? It's already
mm,
been 2.5 years, and
mm,
everybody thought, well into 2023, and literally almost overnight. I think like your show that I was on was almost the beginning. You guys started saying, we're seeing some cracks in the
mm,
armor. So I say that you would think next year will be a very mediocre market based on the indicators, but
mm,
at the same time, we've been in this for nearly 2 years, and through, I guess, my life in trucking of 4 or 5 down cycles, they don't last. They're fairly harsh, down hard and deep, and then you get over it and you climb out.
mm,
And I feel like we've reached that point. So
mm, mm.
it may not get great fast, but I don't think it can go down anymore, I guess is a good way to say
Yeah,
it.
yeah.
One thing I think a lot of us can't account for is we know that capacity is leaving, and that's what you hear everybody talking about. We need more capacity to leave. But what happens in a difficult market is drivers run more miles, owner operators run more miles.
Right.
And so we can do the net negative on capacity, but we can't necessarily account for every driver that's running an extra load a month. I mean, on average, our drivers are now doing 90 to 95,000 miles a year.
Mm,
They
mm,
were doing 85,000 miles 18 months ago.
mm,
Company drivers are no different. They're not making enough money either, right?
mm.
So they're probably wanting to run a few extra miles. So it's like we add 5 to 10% more capacity just in the extra miles drivers are running, but we really can't put a metric,
Right.
like we can't count what that means versus how
Mm,
many trucks have left the market. So I
right.
think that's one of the reasons we will continue to have a ho hum market
Mm,
through at least the first half of 2024. But just your gut tells you it's got to get better, right? It's been
yeah.
bad enough long enough that it's got to
Yeah.
get better in 2024.
Yeah, we don't see a lot of upside until the spring. I think the rate of carrier exits will probably still continue at the same clip they are right now. That has to impact spot market capacity. If most of the exits, we know that about 8 in 10 carriers that join the market end up being in the spot market on our load board. So we have a good sense that of what that capacity is doing in the spot market. And if most of the capacity that's leaving the industry is in the spot market, and it only represents about 15% of all loads, that capacity exiting has a much bigger impact on total market capacity. So it looks like we are at the bottom, Todd. Spot rates have been bottoming out for about 8 to 9 weeks, even though they dropped a little bit this week. I think they'll end this year flat, pretty much flat from where we thought they would in the middle of the year. There is some downside to spot rates in January, February, and March, and then they normally pick up. One of the questions we had in the chat section from Miguel Felipe, is there anything particular about January that you would advise carriers to watch for?
You know, trucking used to be so predictable. The fourth quarter was always busy because of the holiday rush, and then you have e-commerce, which just becomes bigger and bigger. And so what we used to say is, to a smart driver, run until December 23rd and take a plane flight home, because so many drivers are taking the next 10 days off, right? Working to get home. And so mileage really goes down, but there's a lot of freight to move. So you can make good money and then take, your time off in January, do your maintenance and those kinds of things. But the world's flip-flopped and things are unpredictable. And a lot of times January can turn out to be a pretty decent month with e-commerce returns and, all that kind of stuff. So, by most metrics, January is a tough month in trucking, but that doesn't mean I would slow down. I would run all the miles I can today.
I think it's interesting with such a diverse demographic in trucking. Different cultures are in the industry these days. A lot of drivers don't celebrate Christmas and will keep running over the new year. So I think there'll be a lot of opportunity regionally. Todd, that kind of brings us to the close of our show. We're a little bit over time. A couple of shout outs before I come back to you, Todd. Got Sales Chatter on tomorrow, Day-to-Day Wednesday, 11 a.m. Landline Now, Sirius XM, 7 p.m. tomorrow evening on Channel 146. Great Freightvine podcast coming out this week. Chris Kaplis is talking to Bill Drygett from Flexport, talking about some of the opportunities Flexport sees with the acquisition of Convoy's tech and how he sees the market evolving. I'll be on Radio Nemo with Jimmy Mack on Thursday. And next week we have Chris Kaplis and Jason Miller, the dynamic duo. They'll be on our final show here at 10 a.m. Eastern, 7 a.m. Pacific. Todd, before we go, how can people get in contact with you?
Hey, Dean, the easiest way is to go to our website, atbs.com, and they can track me down there. Tiamin@atbs.com is my email. 888-640-4829 is our phone number. And happy to talk to anybody that has any questions. And thanks for having me on, Dean. Happy holidays. Merry Christmas to you and yours and everybody that watches the show. And God bless the truck drivers. Thanks for all you do out there.
Yeah, fantastic. Yeah, we'll do a summary of this on our blog post next week. So I'll put all those link details in our blog post. All right. Thanks, Todd. With that, it's time to wrap up our show. Thanks for watching. We'll be back here at 10 a.m. Eastern next week. Be safe, everybody. Thanks for watching.